Professor, I take it you're also a fan of the Jerusalem Post.
Yeah, I read everything. Let's see. Hi folks, how are you? I hope let's see, make sure I'm on. Yep, I'm not muted anymore. So welcome back, and I'm glad to be back live again. I'm sorry about last week, but I don't think I could have done this with Noah on my lap. He's a little squirmy right now, but much too active. But we're back. So let's, in today's session, we're actually going to cover a fair amount of ground, some of it statistical. And I kind of warned you about this last week as coming, because pricing, the real skill set you need is not finance, but statistics and data analysis, because that's what you're doing. You're comparing across companies. So before I start on today's session, given that the sessions from last week were recorded and you might not have had a chance to ask me questions, are there any questions from last week you want to ask about the pricing? Go ahead, Sergio.
I have one, but it's functional. For the projects, for the companies that are losing money, like biotech and things like that, you mentioned that pricing doesn't really work. What do you want us to do?
What do you mean? You can still price them. You'd have to price them against revenues or I mean, you need something in the denominator. Otherwise, you can't do pricing, right?
Yeah. So for companies that still don't have revenues,
then you have to use potential revenues. I mean, you get desperate, right? You have to do whatever you need to do to get. I mean, that's what VCs do. When you have startups, they'll divide price by downloads, by users, by subscribers, by potential revenues, by potential markets, something to scale the price to. So it gets much more and more difficult as you get to earlier and earlier in the life cycle, but you need to scale to something. Okay, so here's what I'd like to do. I'd like to extend pricing today, but instead of talking about pricing within a sector, which is what you traditionally see done. You know what I mean by within a sector: steel company against other steel companies, software against other software. I want to extend pricing to the entire market. You know, the question I'm trying to answer is, how is my stock price relative to the rest of the market? So here's what I'm going to do. I'm going to take the tools we've already developed and extend them to the market. So let's say PE ratios. If you remember the sessions from last week, we said we know what the three variables that drive PE ratio are. It's payout ratio, growth, and cost of equity. Or cost of equity standing in for risk, growth standing in, of course, for growth, and payout ratio standing in for how efficiently you deliver that growth. Now, could I look across the entire market, just as I ran regressions within banks and within beverage companies last week? Can I run a regression across the entire market? I don't see why not. We have the data, we have the tools. So let's think about running a regression for PE ratios against those three variables: growth, payout, and risk, across the entire market. Before we do that though, of those three variables, growth, payout, and risk, which one do you think should dominate in explaining PE ratios? Of all of those three, which one do you think is the most powerful? Growth, payout, or risk? I would say growth as well, right? So here's what I started off with. I started off with a purely statistical tool. I did a scatter plot of PE ratios across US stocks against expected earnings per share growth in the next 5 years, because future growth is what drives it. And here's what I got in the scatter plot. Now, the good news in the scatter plot is, broadly speaking, higher growth companies have higher PE ratios. The bad news in the scatter plot is there's a lot of noise. You know what I mean by noise, right? Look at how much scatter there is around the line. Undaunted though, I said, look, I'm going to run the regression anyway of PE against growth, payout, and risk, but I'm going to run it with open eyes. Let me explain what I mean by open eyes. When you look at that scatter plot, if that is the scatter plot for PE against a variable that should explain it most strongly, what kind of R-square do you think we're going to get on this regression? A pretty low one, right? And not surprisingly, that's what I got. I got an R-squared of about 25%. You're saying, that's terrible. Hey, you know what? It is what it is. I wanted to use intrinsic valuation. You kept insisting on using pricing, and I'm saying this is what the reality is. There's a lot of noise in pricing. The regression just holds up a mirror to the process and says there is a lot of noise. Now let me look at the regression output itself and let's read it. So the R-squared at 25% means that the regression can be used, but there'll be a lot of noise on your forecast. There'll be a big range on your forecast. The constant that I got when I ran this regression at the start of 2020 was 9.39. That's the base from which I'm going to build off. It tells you something about the overall pricing of the market. The coefficient of the beta is minus 6.03. You're saying, what does that tell me? If your beta is higher than mine, this tells me how much lower your PE ratio should be. For every 1% increase in the payout ratio, my PE ratio increases by 0.2. So if your payout ratio is 20% higher than mine, you should have a higher PE ratio. And every 1% increase in my growth rate increases my PE ratio by 1.37. So if your company has a growth rate 10% higher than mine, it should have a PE ratio roughly 13.7 higher than mine. I've actually captured how PE ratios vary across the market and captured how, as these variables change, the PE ratio will change. I'll have to tell you though, I got incredibly lucky in terms of the coefficients. And here's what I mean by lucky. All the coefficients have the signs I expect them to, right? Higher the beta, the lower the PE. The higher the payout, the higher the PE. The higher the growth, the higher the PE. You're going to see in a minute why this was a little bit of luck. Because when I ran this regression, I was assuming that there was a linear relationship between these variables and the growth rate and the PE ratio. What I mean by a linear relationship is I'm assuming is if growth doubles, the PE should double. That's what a linear regression does. And we know, in at least in theory, that the relationships between PE and growth are probably non-linear. So I'm pushing a linear relationship. The second assumption that I'm making, and this is a problem potentially in the regression, is whenever you run a multiple regression, which is the regression that I've run. I don't know whether you remember your statistics classes, but the independent variables that I use are supposed to be independent of each other, or uncorrelated with each other. In fact, in statistics, there's a word for when they're correlated. It's called multicollinearity. I remember listening to this term in my statistics class, like, who really cares? I should have cared more. Because when you have multicollinearity, here's what happens. So your regression coefficients start to lose meaning. What that often means is while you can still use the overall regression, you cannot read the coefficients as indicating what that coefficient tells you about the independent variable. At the risk of getting this even more abstract, so that's one issue is the correlation across the variables. The second issue, and this is more of a practical issue, is when you run a regression, the intercept can sometimes be negative, right? So you can get minus as your intercept. You're saying, what's the big deal? I can't have negative PE ratio. So one of the problems you have when you have a negative intercept is, what do you do about it? There's actually a default in every regression where you can set the intercept to go through 0. In other words, what it forces the regression to do is change the slope and push the regression through 0. So if you use Minitab, use SPSS, use any statistics package, and you run a regression, you sometimes see this option, even within Excel. And when you run it through 0, what happens is the intercept will disappear, and you just get the coefficients. So now in my example, for instance, in 2019, when I ran this regression last year, when I ran this regression for PE ratios against the variables, I got a negative intercept. And I did not want a negative intercept because that would have given me negative PE ratios, so predicted PE ratios for companies. So last year, I actually reran the regression without the intercept. And what you get then is no intercepts. So this is the output from the regression. The rest of the regression looks very much like the regression you just saw. It has beta, payout, and growth. Now, generally speaking, you don't want to force the intercept through 0, but if you have a negative intercept and it's a big negative number, you can get over it by using this constant. Now, talking about the multicollinearity. I took my 3 variables, beta, payout, and growth, to look to see whether I met the test of independence. And you know what? They're not independent, and I should not be surprised. Think about it. High beta companies will tend to have high growth or low growth. If I take high beta companies, will they tend to be high growth companies or low growth companies? They tend to be high growth. High beta companies, will they tend to be low payout or high payout? They'll tend to have low payout. Here's why, because the high growth and the low payout go together. So usually you get high beta, low payout, high growth. In other words, they correlate. You have multicollinearity in this regression. There are actually elaborate statistical fixes for this. I'm not even going to go down that road. This is not a statistics class. But here's what I take away from it. Sometimes when I run these regressions across the market, the coefficients will have the wrong sign. Last year, for instance, when I ran this regression across stocks, maybe 2 years ago, the beta coefficient was positive, which makes no sense by itself, right? High beta companies should have lower P ratios, but the multicollinearity can sometimes cause signs to have you can get the wrong signs in a coefficient. Be ready for this. When you run regressions for your company against other companies in your sector, you can sometimes get the wrong sign on growth or risk or payout. It is what it is. Don't fight it. It's what the data gives you. You can still use the regression. You just can't read too much into the coefficient. So here's how I'd use this regression. If you believe this regression, and for instance, let's take the 2020 regression. That's what it looks like. And I asked you, do you think Disney is underpriced or overpriced? Here's what you can do. You can take that 15% growth, the growth rate for Disney. Let's say the growth rate is 15% in earnings per share. The beta is 1.25 and the payout ratio is 20%. You can plug those numbers into the regression and you can try it out. So plug in the beta 1.25, plug in 0.20 as the payout ratio, and plug in 0.15 as the growth. I think you come up with a predicted PE of, I'm not sure, 26 point something. You're saying, what does that tell me? It tells me that to the degree that I trust this pricing across the market, Disney is slightly underpriced at 25 times earnings. I could be a one-person hedge fund. I could take this regression, plug the numbers in for every company, get predicted PEs for every company. And those companies that are trading at actual PEs well below that predicted PE are my most underpriced companies. And those companies that are trading at actual PEs much higher than the predicted PE are my most overpriced companies. I'd buy the underpriced, sell the overpriced. Remember, I'm a hedge fund, and hope that the numbers move back towards my average, towards my regression. So the nice thing about a regression is it takes all of this data, messy data about thousands of companies, and puts them in a form where you can actually use it to get predicted PEs for an individual company. And don't expect what you get as an answer here to match up to what you got in your intrinsic valuation of Disney or even your sector valuation of Disney, because you're asking a different question. Is my stock under or overpriced given how the rest of the market is being priced? So I threw a lot at you in those 4 pages. So I'm going to pause. If you have any questions, this might be a good time to ask them, because this is something I do at the start of every year, run these market-wide regressions. And I don't do it because I'm intellectually curious, but it gives me a simple and a very quick way of pricing individual stocks given how the market is being priced.
So what is the bare minimum Rsquare you would expect from a regression to be?
Rather than think in those terms, if you go back to the previous page, think in terms of the T statistics. Let me go back to the page of the regression. See these T statistics? They're all statistically significant, right? All low R squared will mean is when I make a forecasted PE for Disney, for instance, and I come up with 26, I can actually get a range on that forecast based on this regression. And in this regression, the range is going to be from 22 to 30. So what that effectively means is Disney has to trade outside of that range for it to be underpriced or overpriced. So what a low R squared does is it creates a bigger range in your forecast. So your stock has to be more mispriced for it to be something you act on. So don't have a cutoff on the R squared. Look for the T statistics. That's a good test. But then think about the forecast range you get and whether your stock is underpriced or overpriced relative to that range. Make sense to you, Barry?
Professor, where did you get that range from? Like 22?
Oh, it actually is part of regression output. So I actually didn't show it you, but when you run a regression and the forecast you put in the actual numbers, there's actually a very simple regression formula that you use. It's purely a statistical formula. It's not a finance formula. That's a function of the R squared. Let's take the limited case where R squared is 100%. What's your range going to be? If your R squared is 100%, your prediction is going to be perfect. If your R squared is going to be 80%, the range is going to get wider. But the ranges come from the standard errors in your coefficients. So it's actually output from the regression. So if you have any good regression package, not only should you get a predicted PE for every company, you should be able to ask for the 90% range for every company.
Okay.
Yeah, go ahead.
I may have not grasped this fully, but am I correct in assuming that this will have biases towards some industries, like if it's a slow cycle in steel right now?
Yeah, it'll find entire sectors to be underpriced or overpriced. That's why you should do both, right? In a sense, this will tell you, if you're a portfolio manager, this might help you in your sector allocation judgments. And within sectors, if you say, which steel company should I buy, doing the sector pricing might allow you to do this. So if you think about investing is done in stages, there's asset allocation, there's sector allocation, there's stock picking. What you're doing at each level helps you make that judgment. But you're right, entire sectors can be overpriced for this. So you might find that the entire young tech sector is overpriced relative to the rest of the market when you run this regression. But that's a good thing to know, right?
Understood. Thank you.
Jessica?
Yeah, one question. Just if you go back to the slide where you force the intercept through zero.
Yeah. I'm sorry. Yeah.
How come the beta there, the
coefficients? Remember I said because of the positive. This is from last year. And last year I had an issue with the beta coefficient with and without the intercept. The coefficient was positive. But you know why it's positive? Because the multicollinearity makes the computer really confused. Because remember, all the computer sees are 4 columns of numbers. But let's say all your high growth companies also have high betas. The computer gets really confused about whether beta is a measure of risk or whether it's a measure of growth. That's what the multicollinearity will do. So sometimes with multicollinearity, the coefficient, the signs in the coefficients will not make sense. Nothing you can do about it. That's the nature of multicollinearity.
Okay, thank you.
Okay. I can't hear you. Are you? You got to speak a little louder, but go ahead.
For the growth rate, did you just use the next year growth rate?
No, because remember in a regression, it's got to be future growth. But to the extent that you need this remember I have to do this for 2,000 companies. So I need a measure of growth that's available for most of those companies. So let's say you're doing this on a sector with 30 companies. Only 4 of them have 5-year expected growth, but 26 of them have 1-year expected growth. You know what you should do? Just use the 1-year expected growth because you have more companies that come through. That's the kind of judgment call you might have to make based on the availability of data. But you have to be consistent. Whatever growth you use for one, you've got to use for the rest as well. Okay. So one more thing before I leave this regression. As I've said, I've been running this P ratio regression for more than 20 years. And what I've done in this page is actually, remember the coefficient this year was 1.37. So let me show you where the 1.37 comes from. See the 1.37, 137, I've just made it to 1.37. I've kept track of that coefficient on growth going back in time to January 2000. So you're saying, what does that tell me? It tells me what the market is willing to pay for every 1% growth. So in the second column, you have the implied equity risk premium. What is that? That's a price of risk. Imagine being a high growth, high risk company and think of your dream scenario. What do you want to do? Do you want the market to charge not very much for risk, have a low risk premium, and be willing to pay a high price for growth? Go back to January 2001. That's a peak of the dot-com boom. do I even have a year below it? No. But you can see the risk premium was low and the price of risk was high. In fact, there might be a January 2000. I can't even see it on my slide. But you can see that you had a low price for risk and a high price for growth. What does that mean? If you are a high growth, high risk company in 2000, the market was paying this immense price for you. Why? Because the price of growth was high and the price of risk was low. Your worst case scenario is the price of growth gets low and the price of risk rises. So when you see market corrections, you'll often see the numbers start to move together. So the start of 2020, the market is paying about 1.37% for growth. That's somewhere in the middle. And the implied equity risk premium was 5.2%. If you ask me January 2020, am I uncomfortable with either of those numbers? My answer would have been no. Of course, there's no way to see that a crisis was coming and things could change. But looking at the price you're paying for growth relative to history might give you a sense of how much am I paying relative to what I've historically paid for a 1% increase in my growth rate across companies. Now let me move to my second multiple. I wanted to do the same thing that I did with PE ratios with PEG ratios. Now remember we said with PEG ratios, unfortunately, growth remains a determinant of PEG ratios. So what I started with was a scatter plot. And when I saw the scatter plot, I got a little nervous. And let me explain why. When you're going to run a linear regression like I did for the PE ratio against all those variables, you want a scatter plot that suggests there's a linear relationship. When I look at the scatter plot, and this might be just me seeing things, it looks to me like there's a curve. If it's not a linear relationship. It's all bunched up. So if I were drawing a line through the best fit line, it would not be a straight line. Now you're saying, what do I do about it? I fall back on a trick that works very well in finance. It might not work in other disciplines. Whenever you get a relationship like the one you saw on this page, where PEG versus growth looks nonlinear, I took the natural log, that small ln that you see on your calculator or on Excel, the natural log of growth. And then I reran the scatter plot. The scatter plot looks much better, right? It looks more linear. And the way this shows up is when I ran my regression for PEG ratios, just as I did for PE, instead of using the growth rate, I used the log of the growth rate. It's a very quick and sloppy trick. I'm sure your statistics professor would be flabbergasted that you didn't do more work and checking out more transformations. But for me, the log works 90% of the time. I'm not going looking for trouble, squaring, exponential, whatever else. I just ran the regression with beta payout, net profit margin, and log growth against PEG ratios. All the T statistics are significant. The R-squared is actually pretty impressive, 45%. And if you ask me whether a stock was underpriced or overpriced based on PEG ratios, I could plug it into this regression. So when you get a nonlinear relationship, the easiest way to see if it's nonlinear is to run the scatter plot first. If you get a chance, watch the Valuation Tools webcast that I'll put up this week, because I take a sector and I actually run through these tests, or I might have put it up on Friday. But basically it lets you see the statistical ways you can check for nonlinearity, so you can run the regression in a way that captures the nonlinearities. Now, just as if you've forgotten your statistics, I'm sorry, will be obvious for most of you, and you don't need me to say this, but when you run a regression, don't be focused on the R-squared. Look at the T statistics. And if your T statistic is less than 1, just take the coefficient out of the regression, even though in theory that coefficient should matter. Let me explain. You are running a regression of P against growth and risk, and you know that high growth companies should have higher P ratios. But when you run the regression, growth has a T statistic of only 0.5. Take growth out. There's no point adding noise to regression. Another simple rule, don't overload your regression. What that means is if you have a sample size of 25, don't throw 4 variables into your regression. As a general rule, here's what you should think about. If for every 15 companies in your sample, you can add 1 additional independent variable. So basically, we have only 15 companies in your sample and you want to run a regression, have only 1 independent variable. If you have 25 to 30, you can have 2. If you have 40, 45, 50, you can have 3. If you have 100, you can have 4 or 5. But don't run a multiple regression with a very small sample, because your independent variables will start to implode. You might get great looking R-squareds, but terrible regressions. So remember your statistics when you run these regressions. Any final questions before I just show? I mean, I'll just summarize my regression from the start of 2020. I won't talk too much about them because I run these regressions for I think 6 different multiples, and I've run them for US companies, global companies, emerging market companies, European companies, basically by region, by multiple. But before I do that, I want to get any questions about these market regressions before we move on. Since you don't have questions, I have one. Now, remember that regression from the start of 2019 or 2020 that I ran for PE ratio? Can I use that regression today to get a predicted PE for a company? Why not, Nathaniel? Or Flavia? Why can't I run that regression? Because the markets drop, right? And in a sense, one of the problems is with these market regressions is they're only as good as the day they run. Most years I can get away with using it over the course of the year. Now, it's not, Nathaniel, it's not just the expected growth rates have changed. The PE ratios for the entire market have changed. So I'm not going to ask you to run market regressions. It's too much work. And I'm going to let you use my 2020 regressions to get a predicted PE for your company. But don't be surprised to find many of your companies are underpriced relative to that regression simply because the market has changed. Okay? So I'll very quickly review what the regressions look like at the start of 2020. This is my PE ratio regression. I have payout, beta, and growth. No, these are not kitchen sink regressions. You know what kitchen sink regressions are? We've all been guilty of running them during statistics classes. The end game is to get a higher R-square. So you know what we do? We keep throwing variables in there to keep the R-squared going up. These are regressions where I've restricted myself to the variables that showed up when I did remember when I did the algebra on a DCF model to see what drives PE ratios? Beta, payout, and growth. So I ran it for every part of the world. You're saying, what happened to beta in Japan? The beta coefficient was not statistically significant, so I took it out of the regression. So if you gave me an emerging market company and said, can you tell me whether this stock is cheap or expensive, and I have only 3 minutes to run the analysis, I could plug the beta, payout, and growth for this company into this regression for the emerging markets and come up with a predicted PE for a company. So that's my PE ratio regression. Price to book, again, beta, payout, growth, and return equity. The same 4 variables that showed up when I ran my analytics on price to book. Again, across. Now, the key thing as you look at these regressions is there are differences, obviously, in the coefficients. But they also share a lot more in common. Return on equity is the dominant variable in pretty much every market in the world in explaining price to book ratios. That's a lesson to keep in mind. We share more in common across markets, and we realize in these regressions bring them home. Here's my EV to EBITDA across markets. I have the debt ratio as a stand-in for risk. You're saying, why aren't you using betas? Because enterprise value is a firm-wide multiple and beta is an equity risk measure. So I use the debt ratio as my stand-in for risk. Growth being growth in revenues, not growth in net income, because again, this is an enterprise value multiple. It's a subtle shift. And if you cannot find growth in operating income or revenues, you can use growth in net income, but I use growth in revenues. And I use tax rates because EBITDA is pre-tax. So I need to figure out differences in tax rates across companies and countries. Again, across markets, January 2020. There's EV to sales. Again, by now you should see the pattern. Operating margin pops up. Why? Because it's a variable that I found matters with EV to sales. Alex? Go ahead, Alex.
Yeah. So, what do you expect us to do if we have like a global company with multiple revenue streams?
You know what? Do your sector pricing. That I expect you to do on your own, right? So download the sector it's in, make your own judgment as to whether you want to compare it to just domestic companies or global companies. Remember the sample size issue. I ask you to do a market pricing, pull the regression that you think best reflects the market you want to compare your stock to. I'll give you an example. If you take a stock like Infosys, Indian company, but it's an ADR, there are a lot of foreign investors, you might decide to run it through the global regression rather than the emerging market regression. So make your best judgment about which market it belongs to. You can take my start of 2020 regression and plug the numbers for your company into that regression. Perry, you have a question about Minitab? Is that what
that was like 4 slides ago.
Oh, sorry. I use SPSS. I find it more powerful than Minitab. I know, but they all do the same thing. Nothing we do is rocket science. So any basic statistics package will work for you. I use Stat Plus on my Mac, which is an add-on to Excel. Why? Because it allows me to do things within Excel. But any good statistics package will do. So don't spend too much on it, but at the same time, get a good statistics add-on to Excel. Siki?
Yeah, Professor, if I understand correctly, the T statistics represent the significance and how close this factor relate with the entire formula. Well, the R-square represent
the predictive
this line, this line
the predictive power of the entire line.
Yeah. Did you try to do what you did on the other one, the log one, to test if the R-square can be increased?
But remember, you shouldn't be doing the log. You shouldn't do the log of growth unless it's nonlinear. Don't do it just because it improves the R-squared. In other words, don't do transformations of variables just because the R-squared goes up, right? You do it only because there's a nonlinearity. The PEG ratio was the only multiple on which there was significant nonlinearity. That's why I did the log. The R-squared even with the regular growth with PEG ratios is pretty high. It's much higher than it was with P ratios. So it wasn't the log that pushed up the R-squared. It's just the PEG ratio is easier to explain.
But if this is the case, if the R-square is remaining very low number, then its prediction is not very accurate.
So well, you know what the lesson from that is? Don't do pricing. That's basically it, right? Because all in our regression is just holding up a mirror saying, I can't explain differences in multiples based on fundamentals, and you're using a multiple to price a company. You should be very scared, right? That's basically what the R-squared tells you. So as you try to decide which multiple to use for your company, one of the things you might want to check is the R-squareds of different multiples. That's one of the factors that makes you decide, hey, I'm going to use price to book ratios for my company rather than price earnings ratios. So do the best you can because you can't fight the data. Some sectors you'll have a much tougher time than others.
Okay, if I can improve the R-square and then make the T-statistic significance enough,
I'll give you the limiting case. You might have a company where none of the R-squareds have any statistical significance. In which case, you know what you should use for your pricing? Just use the average PE for the sector and move on.
Okay.
That's all you can do, and it's not your fault, right? It's in that sector, nothing works.
Okay. Yeah, thank you.
One final regression, I use EV to invested capital, and notice again, return invested capital pops up. Remember what I said about companion variables. You see the companion variable in the regression, it's almost always going to be the variable with the highest T statistic. Samir?
Yeah. What would you say is an acceptable R-square to use that ratio?
There is no acceptable R-square, right? If it's statistically significant, all an R-squared will do is it'll give you a bigger range on your prediction. Remember, your job is to buy or sell. So all that a low R-squared does, it gives you a bigger range, which makes it more, less likely that you'll find your stock to be underpriced or overpriced. It's going to be more likely to be within that range. So in a sense, the prediction takes care of it, right? The range gives you the sense of whether you buy or sell, and you'll have a bigger range with a lower R-square.
Right. No, what I was trying to ask was, I understand what you're saying, but when you were answering Siki's question, you mentioned, we decide the multiple based on the R-square.
Because you get a tighter range with a higher R-squared regression, right? So basically, let's say you take 4 multiples. P gives you 15% R-squared. Price to book gives you 60% R-squared. EV to sales gives you 40% R-squared, and EV to EBITDA gives you a 20% R-squared. All I ask you to do is a pricing for your company and ask you to use all 4 multiples. So which of those? So you'll use the price to book. in your choice. And that's what I meant by picking the highest R-square.
Okay, cool. Thanks.
Yeah. So the pricing game is a it's a very direct game. In fact, I'll be quite honest. I like the honesty of the pricing game if it's played right, because here are the choices you're going to face with your company. What value do you want to use? Enterprise value, equity value, firm value, right? What do you want to scale it to? Revenues, earnings, cash flows, book value. But as we noted at the start of the class, you might have no choice. You're valuing a company which has no earnings and very little in revenues. You might have to use something like potential revenues. Then you have to decide on timing. Do you want to divide by current earnings, trailing earnings, forward earnings? And I feel sorry for you because you're at a cusp, right? Because the trailing earnings are going to be from 2019. And 2020 is going to be a potential disaster for many of your companies. Can you imagine pricing an airline today? If you use trailing earnings, everything's going to look incredibly cheap. You'd love to have forward earnings, but the problem is you might not be able to get those forward earnings in time. So you might have to come up with your own compromise, current, trailing, forward, or really, really forward. And finally, you have to make a choice in your peer group. Now, are you going to look at only companies within your market? Are you going to go global? Are you going to look at companies of similar size? You have to make judgments and you have to use a feedback loop, because if you're too tight in your criteria for what you include in your sample and you end up with a sample size of only 5 or 6, I would suggest you be more liberal in how you define comparable. So what value, what do you scale it to? What's the timing of that, of whatever you're scaling it to, and what are your comparables? Any final questions before we end up in pricing? Darshan?
What would be the sample size that you would recommend?
Remember I said you need at least 15 companies to have one independent variable in your regression?
Right.
So the more you want to throw into the regression, the bigger, and that's the reason I feel okay with large sample sizes, because I know with large sample sizes, I'm going to get companies that are not quite like mine in terms of growth and risk and payout. But you know what compensates for that? With a large sample size, I can run a regression with 4 variables. So I think actually it's better to have a larger sample size and let your regression control for differences than to go for a really small sample size where you're trying to eyeball the company and say, is that company just like mine? So closing thoughts on pricing or relative valuation. When you price a company, remember, you're not telling me it's cheap or expensive. You're just saying it's cheap or expensive relative to the other companies you compared to. It's a very different judgment call than what you do in intrinsic valuation. And second, there are no companies that are just like your company. No matter how carefully you try to control for differences, there will remain differences across companies. Every company is unique. So keep in mind, pricing is a good tool to have in your toolkit. It comes with its limitations. You're constrained by the data. Do not fight the data. Okay? So let's review. When you look at a multiple, define the multiple. Make sure it's consistent. Make sure it's uniformly estimated. Describe the multiple if you can. Put up a histogram even within your sector. See what the multiple looks like. What's high, what's low. Check for bias in terms of the companies you throw out. Every variable you add to your process might result in companies being lost. Check for bias. Then analyze the multiple, right? Do that algebra. See, what am I controlling for? I've done the algebra for you on 7 or 8 multiples. Go back and review that algebra. Only then should you use the multiple. Define, describe, analyze, apply. I know it sounds like ritual, but go through that ritual. I still go through it every time I look at a multiple because it forces me away from the shortcuts that can get me into trouble. There are no questions. I'm going to move on to the next phase. Any final questions on pricing before we move on? Okay, so
I had one more question, sorry. So if we are looking at a company which has global revenue and therefore we have, I mean, if I only go for a comparable company case scenario, I have like 400 sample size of 400 across the globe. Now, how do you suggest I run through all of those? I mean, if I try to pull all of that in one regression, or should I put them in like 4 regressions based on the location?
4 regressions, because you don't have a market cap by region, right? So you could do 4 regressions, but it's a mess. Run them as one regression. But what are you worried about when you throw in companies from different countries? You're worried about country risk, right? So one of the things you might throw into your regression then is a country risk factor, right? So you can run that in Europe. With 400, you get this luxury. You can throw your country risk premium in as an independent variable because maybe emerging market companies in Africa trade at a lower multiple than emerging market companies in Asia. So you might throw in country risk. You can even use the dummy variable 0, 1 that I used for one of my regressions last week. But you need to control for differences. But I wouldn't run. If you have 4 different businesses, maybe you can run separate pricings for each business and then add them all up.
Right.
But in fact, we're going to talk about that in the next segment. But don't run 4 regressions just because of geographical breakdown.
Okay. Thanks.
Yeah. So if there are no other questions, here's what I'm going to do. I'm going to move on to asset-based valuation. When asset-based valuation, now let's review. In intrinsic valuation, you value a company based on its fundamentals. In relative valuation of pricing, you price a company based on how similar companies are being priced. In asset-based valuation, you use either intrinsic valuation or pricing to value the assets that the company has individually. So I'll give you a very simple example. You have a real estate company with 5 real estate holdings. I could value the entire company as a company, or I could take each holding and value it individually and add up the numbers. This is often what people talk about when they talk about sum of the parts valuation. So let's talk about why you might want to do asset-based valuation. What are the contexts where you're required to do asset-based valuation or forced into it? The first is we have to do a liquidation valuation of your company. A liquidation valuation is when you want to break the company into pieces and you're selling off the individual pieces. You want to see what you can attach as a number to each piece. So that's one scenario. The second is, in the last 20 years, we've had this move towards fair value accounting. And put simply, I think fair value accounting is just make work for accounting day, because here's what it allows accountants to have to do. They have to come in every quarter or every year and reappraise the values of the assets on your balance sheet. That didn't used to be the case. The old balance sheets, you recorded what you paid for an asset and stayed on. But with fair value accounting, you now have to fair value those assets. So with that accounting mission, if you look at the big appraisal firms, whether it's Deloitte or Ernst & Young or Duff & Phelps, a big chunk of their business comes from that accounting mission of fair value accounting. So it could be liquidation, it could be fair value accounting. Because in fair value accounting, you have to value the individual assets separately. Or it could be because you're private equity or a hedge fund that is trying to buy a company to break up and sell in pieces. So liquidation, so you might be doing an asset-based valuation for liquidation, for accounting fair value, or for a sum of the parts valuation by somebody planning to break a company up. Let's look at how you can do it. Because people often talk about asset-based valuation as separate from intrinsic valuation and pricing, but that's not true. Because to attach a number to an asset, I can either use intrinsic value by doing a discounted cash flow valuation of the cash flows from that asset. I can do a pricing of each individual asset, or I can even trust book value if that's what I want to use. So which one you use will depend on what kind of assets you have and what your mission is. Let me explain. Asset-based valuation is easiest when you have separable assets. I gave you the example of a real estate company with 5 real estate holdings. That's an easy case. Each real estate holding is independent. I can value it separately. Imagine trying to do an asset-based valuation of Disney and think of how much more difficult it's going to be. And here's why. You really can't value Disney theme parks separately from Disney movies, right? Because they feed off each other. There's an interaction effect. The more interactions there are, the more difficult it becomes to do asset-based valuation. Can you really value Instagram separately from Facebook? I don't think so. And can you value YouTube separately from Google? Again, it's very difficult to tell where one ends and the other begins. So the first thing you need is assets that are separable. The more separable they are, the easier it becomes to do asset-based valuation. Second, it's nice if those assets have their own earnings and cash flows. Think back again to the real estate example. You own 5 rental properties. Each rental property, I can identify what the rental income and expenses are on that property. It becomes easy to value that individual property. In contrast, if you think about a company like Disney, Disney might report operating income by business, but it's based on allocated expenses, much more difficult to think about standalone earnings and cash flows. And third, it'd be nice, especially if you're doing pricing, if that asset had a marketplace where I could go look up the pricing of the asset. Again, think about real estate. The reason those 5 real estate holdings are easy to price is because I can look at what properties around that holding sold for and attach a price to each asset. So if you think about the 5 real estate holdings company as the easiest case, you can think about really messy cases where it's much more difficult to do asset-based valuation. So the easier it is to separate, the easier it is to get earnings and cash flows. And the more you can find an active market for similar assets, the easier these asset-based valuations become. Now, before I move into the mechanics, any questions up to there about either the motivation for why we're doing asset-based valuation or about when it's easiest to do? So let's talk about liquidation valuation. In liquidation valuation, you're attaching a value that you would get if you liquidated the firm today. So guess what? You have to go sell each asset in the market today, right? If you think about it, you have to sell the asset. Are you more interested in the value of the asset or the pricing of the asset? It should be the pricing. So if you're doing liquidation valuation, we should probably call it liquidation pricing because you're looking to see what price you can get for each of the assets. And if you're in a hurry, you might have to attach a discount to the price. So if you ask me to do a liquidation valuation, I'm really going to use pricing tools, EBITDA multiples, price earnings ratios to attach a pricing. And I may even attach a discount on that pricing because I have to sell in a hurry. So liquidation valuation is more pricing than valuation. What about fair value accounting? I think it's a misnomer. And here's why. If you look at FAS 157, which is the governing rule for fair value accounting in GAAP, and there's a similar rule in IFRS, here's what it says. The number you attach to an asset should be what a market participant will pay for that asset if you did an arm's length trade today. In other words, if you tried to sell the asset today, this is what a market participant would be willing to pay. That's what FAS 157 requires you to put as a number in an asset. Read that over again. Is that a pricing mission or a value mission?
Pricing.
It's obviously a pricing mission. So when you do fair value accounting, you're really doing fair price accounting. I don't know. Did any of you work at an accounting firm doing fair value accounting in a previous lifetime?
Yeah.
Okay. So Darshan, did you struggle with DCF models because that's what the accounting rule writers asked you to develop, and you often ended up with values very different from the numbers you wanted to see?
Yeah, it doesn't work well when you give accountants the leeway to assume things.
Yeah. So in a sense, here's the problem with fair value accounting. They've given you a mission to attach a price, and then they ask you to do a DCF to back up that price. And it's stupid. It makes no sense. And I've told accounting rule writers this. Make up your mind. Do you want fair value or fair price? If it's fair price, call it fair price accounting, and don't ask people to do DCFs because it's a wrong tool given what you've asked them to do. So accounting valuation is really accounting pricing because fair value accounting is fair price accounting. And we should be talking about pricing tools, not DCF models in accounting. Which brings me to what I really want to talk about, sum of the parts valuation. I'll be quite honest, you'll see a lot of equity research analysts talk about sum of the parts valuation when in fact what they're talking about is sum of the parts pricing. It might sound like I'm playing on words, but I'm going to take United Technologies and illustrate what you would need to actually do a sum of the parts valuation. And you're going to very quickly see why most analysts don't want to do sum of the parts valuation. So for those of you who are not familiar with United Technologies, think of it as a poor person's GE. Yeah. It's actually in multiple businesses, a conglomerate. It's in very different businesses. It owns Carrier, which is in refrigeration systems, Pratt & Whitney, which is a defense company, Otis, which is the elevator company, UTC Fire and Security, which is obviously a security company, Hamilton Sundstrand, which is a manufacturing company, Sikorsky, which makes those helicopters, an aircraft company, 6 different businesses. The reason I picked United Technologies is they're very good about providing information broken down by business. Not just revenues and EBITDA, but they even give you CapEx and depreciation and total assets by business. You're going to see why I need all of this in order to do sum of the parts valuation of United Technologies. I do want to mention that the company also has an unallocated expense of $408 million. You say, who the heck cares? I'm going to come back and ask you to tie up that loose end after I've done a sum of the parts valuation of this company. So there's my pre-tax operating income for my 6 businesses, CapEx, depreciation, EBITDA, and revenues by business. You can already see why doing a sum of the parts valuation is easier for a company like United Technology than for other companies that might not give you this level of detail, because you're not required to by accounting standards. You have to break down revenues and EBITDA maybe, but not the rest of the stuff. So here's my first route. I decided to go the easy route. I wanted to do a pricing of United Technologies. And I took the easy route by taking, I know the EBITDA for each of the 6 businesses. I took the EV to EBITDA for the sector in which each business operates, and I applied that multiple to the EBITDA. So I've got an EV to EBITDA for the sector multiplied by EBITDA. In the last column, I get a pricing for each of the sectors, and you add them all up, you come up with the total pricing. And I should be very careful. So the sum of the parts pricing of United Technologies of about $61.7 billion. So basically it's so I could have used EBITDA, I could use revenues, I could use pretty much any number that's broken down by segments. In this case, I went with EBITDA. I've got a pricing. As most equity research analysts, this is all they do. This is like a back of the envelope, sum of the parts number. Because I've really not differentiated what United Technologies refrigeration system business looks like from the rest of the companies in the sector. So here's my second try. I said, let me be fair. And to do this, here's what I did. I said, why do I have to use EBITDA multiples for every business? After all, what I want is an enterprise value by business. I'm going to find the multiple that works best within each segment. So for refrigeration systems, I tried different multiples. Remember, I said check the Rsquare. The multiple that had the highest Rsquare was EV to EBITDA. In the defense business, it was EV to sales. In security, it's EV to invested capital. So I basically picked different multiples for each business. I ran regressions within each sector. You're saying this is a ton of work. You're right. Some of the parts pricing, if you do it right, is a ton of work. I ran 6 separate regressions. So this is a variant of what Perry suggested for geographies, but here I'm running it by business. I got a multiple for each segment. And that regression is what I use to get a predicted value. And that predicted value, and then you can see the last column. That predicted value gives me a total pricing for United Technologies that reflects the differences between the businesses they own and the rest of the sector. So think of this as a slightly more sophisticated pricing because I'm allowing for different multiples for different segments and using them to come up with predicted pricings for each segment. So I plug the numbers for United Technologies into each of those regressions. So all I'm doing is instead of using one industry average, I'm just now using a more finesse number. And I come up with the sum of the parts pricing for United Technologies of $74.23 billion. Remember with the naive pricing, I got $61.7 billion. With the adjusted pricing, I'm getting $74 billion. You're saying, what explains the difference? It turns out that United Technologies' Otis business, for instance, is much more efficient than most of the other construction companies or the building companies that are in my sample. And my regression allows me to capture that and give them a higher multiple. So what I'm doing here is rewarding, United Technologies for the businesses they run better than their peer group and punishing them in businesses where they're running worse than the peer group. So it's still pricing, but it's more sophisticated pricing. Any questions?
Professor, in this example, you'd have to, or in this exercise, you'd have to find a lot of companies in each industry, right?
Yeah. Thank God for S&P Capital IQ, right? Imagine doing this by hand. With S&P Capital IQ, this is all I did was I went in and screened for each segment separately, downloaded into a Excel spreadsheet, but I had 6 Excel spreadsheets. And
but then do you even have like 50 elevator companies that are publicly traded?
It wasn't elevator though. Basically, I used that's why my definition of business is a little broader. I defined it as construction. Otherwise you're right. If I just did elevator companies, there's no way I'd get enough companies, right? So you'd have to do larger samples and control for differences.
Okay.
Any other questions? Now you ready? Well, let's do an intrinsic valuation. What year is the United Tech valuation from? 2009, maybe? It's well worth doing an update if you want to. So they have all the numbers, you can do it. No. Are you doing, Hannah, are you doing United Technologies right now? Okay, Simon, you have a question?
Yeah. I have a question on screening companies, kind of to go off that elevator to construction companies. What do you look for that would like really throw off the valuation for like the larger industry as a whole? Like, are there things that you particularly look for that are going to throw off that valuation when going from elevator company to construction company?
We know exactly what to look for, right? So if let's say I'm using EV to sales, what's the biggest thing that will worry me? Differences in margins. If I'm looking at EV to EBITDA, it might be differences in return on capital. That's the advantage of having the regression, right? So basically you can have 50 construction companies. You know the elevator companies have higher margins. So when I apply that industry average EV to EBITDA, that's what's unfair about it, right? I'm giving too low a multiple. By running the regression and throwing the margin into the regression, I'm controlling for it. So don't reinvent the wheel. When you look for variables to control for, go back to that algebra. What are the variables that drive this multiple and try them out in your regression.
Can we do something for businesses that are typically feeding off each other? Say, for example, in this case, Pat and Whitney's defense business will, play heavily with Skiroski's aircraft business. Maybe
you could. So, that's where the breaking down of the assumption of separable becomes tricky, right? Because that's where some of the parts valuations can get slippery. Is the more interaction there is between the businesses, the more you worry about whether you mispriced a business. I'll tell you, when I do this for Disney, I'm a lot more uncertain than I'm doing for United Technologies, because there I'm not sure whether the operating income for the movie business is truly the operating income for the movie business, or whether there's a spillover effect from other businesses. Same thing with the theme parks. So it just means some of the parts valuation becomes more difficult the more interaction there is. And if the interaction is too much, I wouldn't even try it. It's not worth the effort.
No, I was thinking more from a point of view that since United Technologies developed the defense business, it got the connections to the defense world, and that's why it was able to run the aircraft as well as it is.
Yeah.
So can you play something like that?
Yeah. If I was, but remember at this point they're both developed businesses. So if I was selling Sikorsky right now, nobody's saying, well, you know what, you built up Sikorsky because you bought Pratt & Whitney. I'm going to demand the price that Sikorsky is going to be able to get because of its capacity to generate earnings. So why there might be interaction between companies starts to matter less and less as these companies become seasoned companies or seasoned businesses.
Okay.
Any other questions? Javi, you asked, well, how do you choose the best multiple? The way I did it was I ran 3 or 4 regressions within each sector, picked the one with the highest R-squared because it gives me the tightest range. So now let's try to do a discounted cash flow valuation, a sum of the parts intrinsic valuation. You're going to see things get a lot messier. And here's why. To do a DCF, what do I need? I need a cost of capital by business. I need cash flows by business. I need growth rates by business. In fact, I need everything I would need in an intrinsic valuation. So I tried. Sometimes I had to make assumptions, but I'm not going to apologize for those assumptions because they're assumptions you would have to make anyway. So first step, I computed a cost of capital for each of my businesses. How did I do that? Well, one of the nice things about using bottom-up betas like we have is we already have the ammunition, right? So I used the unlevered beta for each business and the debt-to-equity ratio. Here I did assign the same debt-to-equity ratio for all of the businesses because they're all pretty heavy infrastructure businesses. For those of you in my corporate finance class, if you remember the case of Disney, I gave different debt-to-equity ratios for different businesses because I did not think the movie business and the theme park business would have the same debt to equity. So here I didn't think it was even worth the effort of allocating the debt. So I gave them all the same debt to equity ratios. So there's my levered beta, the cost of equity from that levered beta. I did assume that all of them borrowed under the United Technology, because United Technologies doesn't allow divisions to carry debt on their own. They all have the same cost of debt, and the debt ratio is the same. So the last column, you see cost of capital, and you can see how different they are for the different businesses. It's 6.78% for fire and security, but 9.82% for Sikorsky. So different cost of capital, and for each business, that is the cost of capital I'm going to use for my discounted cash flow valuation. Then I said I'm going to get my cash flows, and I wanted to get the ammunition to get the cash flows and the growth rate. So remember how we computed fundamental growth, return on capital times reinvestment rate? I decided to compute the return on capital by business, and here I had to make some judgment calls. I took the total reinvestment and I allocated it based upon the total assets that, so in fact, United Technologies had given me the information in the second column. I took the capital invested for United Technologies. Remember, capital invested is book value of equity plus book value of debt minus cash, and allocated across the businesses based on total assets. So my return on capital then comes from the operating income that they report and the capital invested I've allocated. So if you look at the returns on capital, fire and security is not a very good business, 6.03% return on capital. Pratt & Whitney is an incredibly good business, as is Otis, very high returns on capital. Judgment calls, but judgment calls that I had to make. Similarly, I allocated the CapEx across the businesses, and that CapEx allows me to come up with very different reinvestment rates for the 6 businesses. I was able to do all of this again because of the richness of data that United Technologies provided me for the 6 different businesses. I have different returns on capital, different reinvestment rates. You multiply the two, here are my growth rates by business. Sikorsky and Pratt & Whitney are growing at double-digit levels. Fire and security is growing at only 3%. Different growth rates. I allowed for 6 different DCFs here. On 5 of the DCFs, I allowed for high growth, but fire and security, I said I'm just going to treat as a mature business. So I just used a stable growth model, and I used the cost of capital that I estimated earlier. So before I show you my DCFs by business, you can see that the work involved in doing a full-fledged sum of the parts valuation is a lot, because I have to do not just the cost of capital by business, but the cash flows, the growth rates, the return on capital, the reinvestment rate by business. And if I'm willing to do that, then I come up with a value for each business. So there's my discounted cash flow valuation of each business. And the value that I get across the 6 businesses with a DCF model is about 80.25 billion. So before I tie up the loose ends, let me make sure that the mechanics are clear. For each business, I get a cost of capital, cash flows, pick a DCF model, value the business, and then I add up the values of all of those DCF values to come up with a value for the entire company. Any questions? Now do you see why most analysts, when they talk about some of the parts of valuation, almost never are going to do this? It's just too much work and requires too much immersion in DCF models. I mean, I wouldn't do it unless I have a company like United Technologies, which provides me with the kind of information I would need to do a full-fledged sum of the parts valuation. Some of the parts pricing I'm willing to do, but some of the parts valuation, a lot more work. What's a loose end I haven't tied up though? Before I tell you that United Technologies is worth 80.25, there's one loose end that I kind of mentioned at the start. What's the one loose end? That unallocated, remember that $408 million that's hanging out there? That's expense that's not been allocated yet. You're saying that's wasteful, I'm going to cut it out. Hey, that's a very cynical view of headquarters. You're assuming they do nothing, which might be true sometimes, but there is a reason that there is a $408 million expense. So here's what I did. I took the $408 million expense and I did a discounted cash flow valuation of just that expense. It's all negative, but remember, I can do a present value of a negative cash flow. There's the $408 million. 38% was the tax rate for United at the time that I did this. I used a mature company model, assuming that United is a pretty mature company in terms of G&A expenses. I come up with a present value of about 4.6 billion. I subtract that 4.6 billion from the value of the parts. Do you see why I need to subtract it? These are the unallocated expenses. They have to go somewhere. I am amazed when I see some of the parts pricing, when people just ignore this expense completely, acting as if it's going to disappear the minute you break up the company. Somebody's got to bear these expenses. My value for the operating assets with the DCF model was about 75.7 billion. So that's at the 80 minus that. My value for the operating assets when I did a sum of the parts pricing, remember the adjusted with the regression was 70. So this are pretty close, 74 to 75 billion. I did a top-down United Technology traditional DCF. I got about 71 billion. And the pricing that I got with a very naive, just applying the multiples, which is what most analysts get, was 52 billion. I don't trust the 52 billion. My estimate of value for United Technologies would have been 71 to 75 billion across pricing and DCFs. But that's a pretty tight range. Sometimes you can get a sum of the parts DCF that is significantly higher than a company DCF. That's when you should think about breaking up the company. But to do that right, you have to do a full-fledged intrinsic valuation of each business and make sure that you tie up that loose end. That's overhead. Any questions on some of the parts valuation and what we did here?
Professor, did you subtract the 4.5 billion to arrive at the sum of the parts relative valuation as well?
I didn't. I should have, right? There I should apply a multiple, or I can subtract the 4.5 billion. You could actually apply a multiple just like you did on everything else. But you're right. Even the 74.2 billion, you could argue, is a mispricing because you've missed the 408 million. Or here's the other thing you can do if you don't want to deal with it as a loose end. Just allocate the 408 million across the businesses based on revenues or something, so it's not hanging out there. And that'll kind of take care of it.
Thank you.
Rob asked, have I done a sum of the parts for JP Morgan? You know how much of a nightmare that's going to be? Because of this is the problem. When you have interrelationship between businesses, it gets really, really messy. I would love to separate commercial banking at JPM from investment banking from proprietary trading. But I'll give you my gut feeling. I think the sum of the parts valuation of JP Morgan, it's pure gut at the moment, would be much greater than their market cap today because people don't trust them. Now, if I were advising Jamie Dimon, I'd say break yourself up. And this is what we talked about in the context of complexities. Before we leave some of the parts valuation, a couple of years ago, on my blog, and you can get the full post, and I'll send you the link to this, I did a similar sum of the parts valuation of GE. Yeah. And I did this when GE was in complete shambles. New CEO had come in, the company's clearly coming apart. And I did each part. So basically, you see the different parts there. The reason I've separated the orange, green, and red is I'm sorry, I didn't mean to do that. Orange, green, and red is based on their return on capital, right? The really good returns on capital businesses are the green, the kind of average returns on capital are the orange, the kind of major problematic businesses are the red. So lighting and capital are the problematic businesses, power, renewable energy, oil and gas are the kind of mid businesses, and they have three good businesses. So GE as a company has some good businesses, some kind of neutral businesses, and some bad businesses. But here's their biggest problem, GE Capital. You remember we talked about separable assets? You know what makes GE Capital such a nightmare? Because when I valued GE as a sum of the parts, here's what I got. I valued each part separately. GE Capital, I actually got a negative value for the business. No, because the value of the business was less than the outstanding debt. So ask me the question, why don't they just shut down GE Capital? Why can't they shut down GE Capital? If they could, they would. Why can't they shut down GE Capital?
Because it would hit the sales of other businesses?
Because much of the GE Aviation sales is financed by GE Capital. This is Jack Welch's folly, right? I mean, it made him the legend that he was, which is he built up GE Capital. But then he intertwined GE Capital into every part of GE. Which makes it, so you're saying, why don't we just buy GE and just get rid of GE Capital? How do you get rid of GE Capital? So this value per share is with GE Capital embedded with a negative value. I got like $10.80 per share for a sum of the parts DCF. And I also did a sum of the parts pricing. And I got $11. And if you look at my blog, I actually ended up buying GE at 9 something. It went up, it's now back down. So I think at whatever, $8 or whatever it's trading at right now, it's probably kind of a roughly close to intrinsic value now. I'd have to do an updated valuation. But if any of you are interested, you can use this template and download the Excel spreadsheet and kind of play with it, because the numbers are very easy to get and you can value the pieces. But as I said, the wild card here is GE Capital and how much you value or price it at, because it's going to be what determines whether you end up buying GE or not buying GE. Any final questions on sum of the parts valuation? So next time somebody says, I've done a sum of the parts valuation of a company, ask them to clarify. And you're going to see very quickly that what they've done is a back of the envelope sum of the parts pricing of the company, where they apply the average multiple. And that's really not a sum of the parts valuation. It shouldn't be the basis for breaking up a company. It has to be, if you're going to break up a company, then you've got to do it right. You've got to do a full-fledged intrinsic valuation of each business to make sure that there is value to breaking it up. Any questions? I know we have only 11 minutes, but I want to get started on private company valuation. At least lay out why valuing private companies is often so much more difficult than valuing public companies. Let me start off with the good news. The process of valuing a private company is no different than the process of valuing or pricing a public company. You can either do an intrinsic valuation of a private company, or you can price the private company. If you're doing an intrinsic valuation, that intrinsic valuation can be of either the entire company or just the equity in the company. But here are the two standard problems you're going to face with private company valuation. First, there is no market value for either debt or equity for a private company. Second, the financial statements for private companies usually don't have the level of detail that public companies do. Doesn't mean that they're bad, but they're not broken down. You don't have GAAP and IFRS driving them. You're faced with a very different set of accounting principles. So let's see the potential issues that you're going to run into in valuing a private company. First, let's see what the problem is with not having a market value, especially for equity. Remember that there are a couple of places in a DCF where you use the market value of equity. One of the places, obviously, is to get a debt ratio and a cost to capital. Because remember, we use levered betas, which are based upon market debt to equity ratios. So first, we need market values to get our cost of capital. But I'll tell you where you miss market value even more. Many of you have valued DCFs. I've been tardy about returning your DCFs. I'm about a third of the way through. I'm working my way through this week. But in your DCF, most of you valued public companies. And right after you finished your DCF value, remember what you checked it against? You checked it against the market price. It was wildly different. You went back and revisited your valuation to make sure you didn't have an input error. When you value a private company, you don't have that check of the market value, and you don't realize how much you miss it until you don't have it. And thirdly, our risk measures are based on market values, right? Think of how we get betas. We run a regression of past returns on the stock against the market index. You're not going to be able to run those regressions with private businesses because the stock is not traded. So that's the first problem. Here's the second. We talked about cash flows. The way we estimate cash flows for a private company are no different from the ways you estimate cash flows for a public company. But there are four issues you're going to run into with private companies that you might not run into with public companies. The first is, most private companies don't have histories that go back 20, 30, 40 years. Of course, that's true for some public companies as well. You're valuing Zoom, you have data going back only 2 or 3 years. So that's not a big deal. The second is we talked about accounting standards. If you have a big private company, the accounting might look very much like a big public company. But if you have a small private company, the accounting standards can be all over the place. I'll give you my favorite story. About 10 years ago, somebody in a valuation class, very similar to this one, decides to value a mother's flower shop. And I said, okay, that's a good thing to do. Maybe your mother will be grateful for the value, maybe not. So about 4 weeks into the class, the person who picked the flower shop comes into my office in a complete panic. She says, I have to switch my company. I said, what happened? You have a fight with your mom? She said, no, I went and asked my mom for financials, and she led me into an inside room where the walls were all covered with Post-it notes. And I said, Mom, what is this? And she pointed to one wall which was covered with pink notes and said, that's my revenue wall. Every time I sell something, I write the number on a Post-it note and I put it on that wall. She pointed another wall which had green post-it and said, that's my expense wall. Every time I have expenses, I write on a green post-it and post it in that wall. At the end of the year, I pull down all these post-it notes, go to town on them. This is not exactly IFRS or GAAP. I don't think post-it accounting is allowed in either standard, but different accounting standards. The third is with private businesses, there is an intermingling of the personal and the business expense, right? That corporate car every afternoon at 3:30 seems to magically disappear around the time the kids' schools all let out. This happens with public companies as well, but private companies, what's personal and what's business, there's a very gray line. And finally, there is an issue of separating salaries from dividends. Let me explain. If you're an owner of a private business, you get whatever's left over, right? Most owners of private businesses don't pay themselves a salary because what's the point? You get whatever's left over anyway. But when you value a private business, you have to know what's salary and what's dividends. And sometimes you have to make it explicit. You have to work on separating the two. So cash flow estimation issues, while you might estimate them the same way, you still face more challenges with private companies. So I'm going to make a statement about private company valuation that we're going to come back and examine more deeply in the next session. When you value a private company, motive matters. Let me explain. If you come to me, you're an owner of a private company and say, I want a number for my company, I'm going to ask you why. You say, what do you mean why? Do you want to value a private company just because you're curious? Some people want to value for their private business because they want to know. Is it for a legal purpose? Maybe you have to pay taxes based on the value. Is it for a transaction? If it's for a transaction, who are you trying to sell it to? To another individual, to another partner, to a publicly traded firm, to a private equity fund? Or is it a valuation which is a prelude to an IPO? You're saying, why would that matter? You're going to see that the value that I attach to a private company can vary depending on why the valuation is done and who I plan to sell it to. You can also value divisions of public companies as almost like private businesses. Imagine United Technologies spinning off the Otis business. You're going to face many of the same challenges you face with a private company in terms of not having a market price. But things get a lot simpler in that scenario. So motive matters. So I'm going to set out 4 broad scenarios where you might value a private company. The first and the most difficult scenario is for a private-to-private transaction. I'm going to use an example of you as a chef of a restaurant. You own the restaurant, you're planning to sell the restaurant to another individual. A private-to-private transaction. It's the trickiest of all valuations to do, and you're going to talk about why. Second, we're going to talk about a private-to-public transaction. You own a restaurant, but you're selling it to a publicly owned restaurant company that wants to buy a restaurant. Things get a lot simpler. Third, it could be a private company to an IPO. And there are a couple of loose ends we need to tie up about the IPO process that might affect evaluation. And the fourth scenario is you're a private company, you're trying to value yourself for a VC stake being taken in your company. You're on Shark Tank and you're selling 20% of your company, you're trying to put a value. Private to private, private to public, private to IPO, private to VC, potentially to go public sometime way in the future. Let's talk about private-to-private transactions and what makes them tricky. In a private-to-private transactions, you face 3 potential problems. The first is neither the buyer nor the seller is usually diversified. Take a doctor's practice. Doctor's built up this practice over 30 years. He's now selling it to a younger doctor who's going to buy the practice. Neither the old doctor selling the practice, or the young doctor buying the practice is going to be diversified. Why? How can they be? Their entire wealth is tied up at the practice. The second is the investment is illiquid. In other words, once you buy this practice, you can't flip it. It's not like buying 1,000 shares and I changed my mind. So we have to confront this question of illiquidity and how much of a discount you might put on the value because you care about liquidity. And the third is, with private-to-private transactions, there's a key person value. Let me explain. You're a doctor selling a practice. Why do you have so many patients? Because your patients like you, they trust you. You sell the practice to a new doctor. That new doctor might not inherit all your patients because those patients might say, who the heck are you? I don't trust you. So we're going to have to talk about how to incorporate that key person effect into value. So we have to talk about diversification, we have to talk about liquidity, we have to talk about key person values, and those all will make your valuation potentially trickier. So next session on Wednesday when we start, here's what I'm going to do. I'm going to start by valuing a restaurant. And I'm going to put you in the shoes of the chef who owns the restaurant. Okay? Actually, let me put you in the shoes of the person. You're a person, or you're an investment banker. You quit your job, you're going to buy a restaurant. Why? Because you always wanted to own a restaurant. So the owner of the restaurant is going to sell the restaurant. You're going to buy the restaurant. But you're going to use all of your savings to buy the restaurant. So there's no diversification you're going to have after this buy. You have access to the most recent financial statements, and over the last, and I'll give you the last 3 years of financial statements. But in the most recent year, the restaurant was pretty profitable. It made $400,000 in pre-tax operating income on $1.2 million in revenues. The firm has no debt outstanding, but it has a lease commitment on its restaurant properties of $120,000 each year for the next 12 years. So when I start on Wednesday, I'm going to first take on the role of somebody valuing the restaurant for the owner, and I'm going to come up with the value for the restaurant with the historical data. And along the way, I'm going to ask questions that I would not have asked with a public company. Perry asked a very cynical question. Can a key person value be negative? Yes. If that key person is more destructive than constructive. I would say if you're selling Madison Square Garden, any NIC personnel that come with the investment, I would want to get rid of. They're getting rid of a key person. So that's a much easier problem, right? You just fire them right after you buy them. The problem is with the key person has a positive value and you lose them right after the acquisition. So it'll make for interesting valuation. So next session, we will value this restaurant and we will be done with packet 2 next session. So if you get a chance, download packet 3 and now, maybe we'll start talking at least about options on Wednesday. But that's all for today. And before I leave, any final questions? Because I think your quiz is a week from today, and I just wanted to remind you of that. And I'll send you a reminder again on the email with the review session and all the rest of the stuff. But the quiz will cover only, basically, what we've done in packet 2. So essentially, it'll cover everything we do through Wednesday. So that's about it. Any final questions?
Will the quiz be the same multiple choice format as the last one?
Unfortunately, yes. I am sorry because I know some of you don't like the format. But it'll be 5 multiple choice questions. It'll be 1 hour. It'll be exactly the same format. But working through the past quizzes, again, is the best way to get ready for it.
And was there, I didn't see, did you send out a grading curve for the last quiz?
No, I will actually. Now that you remind me, I will send a curve out so that you can see where you are. In fact, I'll send you both the grading curve for the last quiz and a consolidated curve based on the quiz, the 2 quizzes, so you can see where you stand.
Thank you.
Okay. Oliver?
Sure.
Yeah.
Yeah. Hey, I had a question regarding, let me see, sorry, if you're doing sort of the FE valuation, and the company in question owns 20% of a market-listed enterprise that very well might pay expected dividends.
Yeah.
Where do you actually find the value of those?
The dividends should be in your net income already, right? Because when you do FCF, don't add the dividends on, you'll be double counting. If you started your free cash flow equity with the net income of the company, the net income usually includes a 20% of the subsidiary's net income. That's the difference between free cash flow equity and free cash flow the firm valuation. Is net income already includes your cross-holding effect, so you don't have to include the dividend separately.
Okay, thank you.
Okay, folks, if there are no other questions, I'm going to log off for today. My dog's nipping at my ankles. I think he needs to go out. I don't want him to pee on my carpet. So I will see you on Wednesday. Take care.